One number, 13. That is the only number that matters right now. Not the jobs report, not the Fed minutes, not whatever the equity desk is pricing in for the June meeting. 13%? That is how far the paper silver market dropped this week, while the physical market told a story that the paper price has not yet found the courage to tell. I need to know something from you before we go any further. Drop it in the comments right now. What is silver trading at on your screen at this exact moment? Not what it closed at, not what the headline said. What number is your dealer quoting you for a 1-ounce coin delivered to your door in the next 10 business days? Type it, because that number and the COMEX number are not the same number. They have not been the same number since Friday morning. And the distance between them is the single most important data point in this entire market right now. This is Friday, March 7th, 2026. My screen says silver is at $73.40. Gold is holding at $5,088. Those are the paper market numbers. Those are the numbers generated by a pricing system that was designed for a world that no longer exists as of approximately 72 hours ago. The way a photograph shows you what a room looked like before the fire, accurate to a moment that has already passed. Describing conditions that the physical market has already moved beyond. Here is what changed. The Strait of Hormuz, the 21-mile channel through which approximately 20% of the entire world's daily oil supply transits, is no longer functioning as a reliable commercial corridor. Qatar has announced a full suspension of crude exports with no operational timeline attached to that statement. Maersk, which controls roughly 17% of global container freight movement, has pulled its entire regional fleet, citing active naval confrontations, persistent drone strike activity, and insurance underwriters who have stopped pricing the risk at any commercially viable level. Brent crude punched through $89 per barrel before the Friday close, and the directional momentum carries no natural ceiling in the near-term structure. There is no Saudi spare capacity announcement on the table. There is no strategic reserve release large enough to compensate for 20% of daily global supply being cut off by an active military engagement zone. These are not analyst projections. This is the arithmetic of what physically cannot move. And while this is the dominant market-moving event of the year, while institutional desks are quietly repricing the entire energy cost structure embedded in physical commodity production, while shipping insurers are tearing up the assumptions that every mining company's forward guidance was built on, the financial media spent Friday morning explaining why payrolls missed by 35,000 and whether Jerome Powell feels more comfortable with one cut or two in the second half. That is not an accident. That is a feature. The information gap between what is understood by those who follow physical commodity supply chains and what is understood by the retail investor staring at a red candle on a silver chart is wide right now. Wider than it has been since March 2020, and that gap is the opportunity. Let me be direct about what I am. I'm not a broker. I do not manage assets on your behalf. I have no interest in your brokerage account and no financial relationship with any dealer, fund, or institution discussed in this video. Nothing I describe here constitutes investment advice. What I am is someone who has spent years at the intersection of energy markets and hard asset pricing, specifically watching what happens to the cost floor of physical silver extraction, when the energy inputs that power every stage of that process get repriced by a geopolitical event outside the control of any central bank. That framework is not the one taught on Bloomberg terminals. It cannot be, because applying it honestly requires admitting that the paper pricing system routinely describes a hypothetical production environment rather than the physical one. And financial institutions do not build client relationships by telling clients that the price on the screen is a legal fiction with a 100-to-1 leverage ratio underneath it. So let me make the case from physics, not from speculation. Silver at $73.40 is not a market that has digested what happened on Thursday morning. It is a market that closed on Wednesday's assumptions and has not yet reopened with Thursday's reality fully loaded into the mechanism. At $70 per barrel of crude, which was the assumption baked into every mining company financial model, every Wall Street price target, and every futures contract written in the past 3 years, the average all-in energy cost to extract and refine 1 ounce of physical silver runs between $8 and $12. That range is not a fringe estimate. It is the consensus figure embedded in the cost structure every major silver producer reports to its shareholders. Brent crude is not at $70. It cleared $89 on Friday. And it is moving inside a supply disruption with no short-term resolution path on the table. Run the arithmetic. If oil stabilizes at $100 per barrel, which is the logical base case once 20% of daily global supply is operating behind an active military choke point, the energy cost embedded in producing 1 ounce of silver moves to between $15 and $19. If Brent reaches $120, the level it touched briefly in 2022 during the last significant geopolitical energy disruption, that embedded cost approaches $26 per ounce. Before refinery margins are repriced, before shipping insurance is recalculated by underwriters watching the world's second largest container operator abandon an entire trade corridor in a single Friday morning announcement, before the capital risk premium that mining executives will require to continue committing capital in an environment where their single largest input cost can move 25% in a week with no policy ceiling in sight. The paper price has priced exactly none of this. The paper price dropped 13% this week on macro fear, while the physical cost floor of producing the metal the paper price claims to represent was moving in the opposite direction with equal force. That is not a technical divergence. That is a structural dislocation. And it has a very specific and historically documented resolution mechanism. The resolution mechanism is not complicated, but it requires understanding the difference between two markets that share a name and almost nothing else. The COMEX silver futures market and the physical silver market are not the same market. They have not been the same market for a long time. They occupy the same ticker symbol the way a map occupies the same drawer as the territory it claims to represent. One is a legal instrument, the other is a metal. One can be created at the speed of a keystroke. The other requires diesel-powered excavators running underground continuously, energy-intensive crushing and milling of millions of tons of ore, chemical refining processes demanding sustained industrial heat and electricity, and transportation across continents via trucks, ships, and freight networks, every single link of which is denominated in oil. At $89 Brent and climbing, every link in that chain just got more expensive simultaneously. Not theoretically. Not in a model. In reality, this morning, while the paper market was busy generating a 13% red candle that the financial press is already describing as a buying opportunity for patient macro bulls waiting on a Fed pivot, the patient macro bulls are looking at the wrong market. There is a question I want you to answer in the comments right now. What is your local news leading with this morning? Is it the Hormuz closure? Is it the Maersk withdrawal? Is it Qatar's production suspension and what that means for the 1.8 million barrels per day that are no longer leaving that terminal? Or is it still the jobs report, the unemployment tick, the color-coded graphics, and the composed anchor voices explaining things that do not matter? Tell me exactly what your screen is showing, because what you report back tells me precisely how wide the information gap is in your specific geography. And the width of that gap determines how much of this opportunity remains uncaptured by the time Monday's session opens. Here is what the institutional desks that understand Hormuz mechanics are doing right now. They are not watching payrolls, they are making calls, they are placing orders against physical inventory. They are doing the calculation I'm about to walk you through, and they are doing it on Friday afternoon before the paper markets close and go dark for 48 hours. The window to position ahead of those institutional flows does not stay open past the weekend. The Shanghai Gold Exchange opens Sunday night Eastern Time. That session is the first real-time physical price discovery event since the Hormuz closure was confirmed. The premium that Asian physical buyers place above the COMEX paper price in that session will tell you more about where Monday's New York Open is heading than every analyst note that will be published between now and then combined. Watch that number Sunday night. It is not describing what traders think might happen. It is describing what buyers are actually paying for physical ounces in the first honest market session since the world changed. Now, let me give you the three historical templates for what happens when an energy shock of this magnitude intersects with a currency system operating beyond its structural capacity, because the market has already answered this question. It has answered it 3 times in the last 50 years, each time with different surface conditions and identical underlying mechanics. The first template is 1973. The OPEC oil embargo removed roughly 7% of global daily supply from the market over a period of weeks. Not 20%, 7%. Crude moved from $3 to $12 per barrel, a 4-fold increase that transmitted as an inflationary cost shock through the entire global production economy simultaneously. The dollar lost approximately 30% of its purchasing power over the following decade. Gold moved from $35 per ounce to over $800 by 1980. Silver ran from $1.50 to $50 over the same period. That is a 33 times return in under 10 years, driven entirely by the market's recognition that fiat currency cannot absorb a sustained energy shock without structural debasement. Now apply the 2026 differences. In 1973, global debt was measured in the billions. Today it is measured in the hundreds of trillions. In 1973, the Federal Reserve had the operational space to raise rates to the levels Paul Volcker eventually deployed to break the inflationary cycle of that era. Today, with national debt above $36 trillion, generating over $1.2 trillion in annual interest payments at current rates, that policy tool is not available. The Fed cannot Volcker this. The debt service arithmetic will not permit it. Additionally, China was not the world's largest oil importer in 1973. Today, it draws more than 10 million barrels per day through supply routes that now run directly through a closed choke point. The 1973 episode is not a ceiling for what happens when Hormuz closes, it is a floor. It describes the minimum response of hard assets to an energy shock hitting a monetary system under structural strain. The current conditions are more extreme on every dimension that matters. The second template is March 2020. The pandemic forced institutional liquidation across all asset classes simultaneously, and the paper silver price collapsed to $12 per ounce. That is the chart story. The physical market told an entirely different one. At the exact moment the COMEX futures price was cratering, you could not purchase a 1-ounce Silver Eagle from any major online dealer at less than $8 over the published spot price. Delivery windows extended to 12 weeks in some cases. Dealers implemented hard purchase rationing as incoming demand overwhelmed available inventory. Paper said $12. Physical said $20 and climbing, and there's a wait list. When the paper price eventually closed the gap, it did so violently and quickly, locking out everyone who had been watching the chart, waiting for technical confirmation before acting. The entry window at reasonable premiums had already closed before most retail investors recognized it had opened. The third template is early 2023. When regional bank failures began cascading through the U.S. financial system, the physical silver market responded with identical architecture. Premiums moved to $10 over spot. Dealers implemented 100-ounce per transaction purchase limits. Paper and physical diverged, followed the same pattern, and then closed the gap with the same speed that punished patience. The common structure across all three episodes is precise. External shock, whether geopolitical, pandemic, or financial system, causes paper price instability or decline. Physical dealers freeze inventory or reprice aggressively. Paper prices eventually close the gap. But the entry window at reasonable premiums had already shut before most investors registered it had opened. Today is the beginning of that window. The external shock is not developing. It has already occurred. And this time, the energy shock is not arriving into a market with reserve capacity. It is arriving on top of a structural supply deficit that has been compounding for years before this morning changed the production economics permanently. Global silver mine production has been essentially flat for 5 consecutive years. The number is not a projection. It is a reported figure. Approximately 830 million ounces extracted annually from a planet that has been mining its highest grade deposits for decades. The ore grades are declining. The easy silver is gone. What remains requires more energy, more chemical processing, more capital, and more time to bring to surface than anything the industry was operating against 20 years ago. Bringing new production online from a greenfield discovery requires environmental permitting, geological evaluation, infrastructure construction, and sustained capital commitment measured in years, not weeks, not months, years. None of that timeline responds to a Friday morning closure announcement in the Strait of Hormuz. Meanwhile, total annual silver demand, industrial consumption, investment buying, and jewelry combined, has been running above 1 billion ounces per year. The global market is consuming more than 170 million ounces beyond what mining produces every single year. That deficit has been sustained by drawing down above-ground stockpiles accumulated over prior decades, recycling industrial scrap at increasing cost, and liquidating ETF inventory positions that institutions built during lower price periods. Those sources are finite. They were being depleted before this morning permanently altered the cost structure of bringing new supply into existence. Industrial demand does not soften in response to higher energy prices. It accelerates. The urgency of transitioning away from hydrocarbon energy dependency increases precisely when oil approaches $120 per barrel. That transition requires solar panels. Every solar panel manufactured today requires silver. The photovoltaic cells that convert sunlight into electricity depend on silver's electrical conductivity in a way that no currently scalable substitute can replicate at industrial volume. The construction of alternative energy infrastructure, made more urgent by every Hormuz reminder of fossil fuel vulnerability, draws from the same physical supply base that was already running a structural deficit before Thursday. The deficit does not resolve when industrial buyers redirect toward renewable applications. It compounds, because the same energy shock driving the transition simultaneously raises the production cost of the silver that transition requires. Higher oil means more expensive solar panel manufacturing inputs, more expensive silver mining, more expensive shipping of refined metal from processing facilities to fabrication plants. Every vector points in the same direction simultaneously, and the paper price at $73.40 has accounted for none of these vectors. Now layer the monetary demand on top of the industrial base. The buyers who are beginning to reprice their hard asset exposure in response to the energy shock are not retail investors watching YouTube. They are sovereign wealth funds calculating what a sustained Hormuz disruption does to the purchasing power of the dollar-denominated reserves they are sitting on. They are central bank reserve managers in economies that import oil through the affected corridor. They are institutional portfolio managers who have spent 3 years being told that inflation was transitory, that regional bank stress was contained, that the soft landing was intact, and who are now watching Brent crude clear $89 with no policy ceiling available and no spare capacity announcement coming from Riyadh. These buyers are not consulting technical charts. They are not waiting for the 200-day moving average to confirm a trend. They are calling dealers. They are requesting physical delivery. And every institution that moves from paper exposure to physical delivery request runs directly into the leverage ratio that sits underneath the COMEX structure, like a detonation device waiting for a sufficient trigger. Here's the mechanism. The COMEX Futures Exchange does not require that physical silver exist for a contract representing silver to trade. The exchange operates on the documented assumption that the overwhelming majority of contract holders are financial speculators who will close their positions in cash before delivery ever becomes a logistical question. That assumption permits a paper-to-physical leverage ratio that independent analysts tracking registered vault inventory against open interest consistently estimate at between 100 to 1 and 250 to 1. For every single ounce of deliverable physical silver sitting in COMEX registered vaults, between 100 and 250 paper claims on that ounce are simultaneously outstanding in the market. In stable conditions, meaning conditions where no significant fraction of those contract holders ever simultaneously decides they want the actual metal, this structure functions. It is legal. It is documented. It is how the market has operated for decades. But it is not a feature of a stable system. It is a liability of one. In a crisis, it is not a market mechanism. It is a detonation device. When an external shock forces institutional holders and sovereign wealth funds to reassess whether their paper, silver claims are backed by physical metal they could actually take delivery of, they begin requesting delivery. The exchange cannot honor those requests at anywhere near the current paper price. The paper price and the physical delivery price separate violently, which is precisely the dynamic the 2020 and 2023 episodes demonstrated in controlled, smaller-scale form before the underlying cause was resolved by policy intervention. The difference now is that this cause is not correctable through monetary intervention. The Federal Reserve cannot reopen the Strait of Hormuz. The Treasury cannot instruct Maersk to return its vessels to an active naval confrontation zone. The energy cost embedded in every ounce of silver produced going forward has been permanently recalibrated by a geopolitical event outside the reach of any central bank policy tool. The paper market is describing production economics that no longer exist. And the moment that reality becomes undeniable to institutional buyers simultaneously, which is what Sunday night's Shanghai session begins to force, the leverage ratio transforms from a background structural risk into the active mechanism through which repricing expresses itself. The Shanghai Gold Exchange opening Sunday night Eastern Time is the first real-time physical price discovery session since the closure was confirmed. It is not a futures market. It is not a speculative instrument. It is the price that physical buyers in the world's largest gold and silver consuming market are willing to pay for metal they intend to take possession of. The premium that Shanghai physical prices carry above the COMEX paper close on Friday is the opening signal for what Monday morning in New York looks like. It is also the signal that every dealer repricing their weekend inventory is watching right now. Watch that spread, not the chart, not the analyst targets, not the financial media coverage of the jobs report. The Shanghai physical premium on Sunday night will tell you whether the gap between paper and physical is widening or whether institutional demand has already begun absorbing the available inventory at elevated premiums before Monday's open gives the retail market a chance to react. Because here's what the historical template tells us about the entry window. In every prior episode, 2020, 2023, and the structural episodes before them, the window between the external shock and the paper price catching the physical price was narrow, not weeks, days. Sometimes hours after a weekend session repriced the physical market while the paper exchange was dark. The investors who acted during the gap captured the return. The investors who waited for the chart to confirm the thesis found that by the time confirmation arrived, the premium over spot had expanded to the point where the entry was no longer the same trade. The paper price dropped 13% this week. The physical cost floor moved in the opposite direction. Both of those things are true simultaneously. One of them is going to correct, and corrections of this kind do not correct slowly. Let me give you the precise numbers that the paper market is currently refusing to price. Because this is not speculation, this is arithmetic, and arithmetic does not negotiate with sentiment. At $89 Brent crude today, the all-in energy cost embedded in 1 ounce of physical silver sits between $15 and $19. Add refinery margins being repriced in real time by operators who are recalculating their forward exposure to input costs that move 27% in 72 hours. Add shipping insurance being recalculated by underwriters who watch the world's second largest container freight operator abandon an entire regional trade lane without a return timeline. Add the capital risk premium that every mining executive presenting a production forecast to a board on Monday morning will be required to justify against a Brent crude price that carries no natural ceiling in the current geopolitical configuration. The true cost floor of producing 1 deliverable ounce of physical silver and moving it through a disrupted supply chain to an industrial buyer in Europe or Asia is not the number the paper market closed at on Friday. It is structurally higher, permanently, not until the crisis resolves, permanently, because mining companies reprice their break-even thresholds to reflect the capital environment they are actually operating in, not the one that existed before Thursday. The paper price at $73.40 is not a bargain relative to production cost. It is a fiction relative to production cost. The spread between what it costs to bring 1 ounce of silver into existence and deliver it to a buyer through a compromised supply chain, and what the COMEX futures market says that ounce is worth, has never been wider in the current cycle. And it is widening in real time while the financial press runs segments on whether this week's red candle represents a technical support test or a momentum breakdown. Gold tells the same story from a different angle. At $5.98 on Friday's close, gold is already pricing a portion of the monetary demand shift that the energy shock forces. Central banks that have been accumulating physical gold for 3 consecutive years, the documented accumulation cycle that began when the dollar weaponization of Russian reserve assets demonstrated that paper claims on assets held in foreign jurisdictions carry sovereign risk, those buyers are not selling into this, they are accelerating. The gold to silver ratio sitting above 69-1 at current paper prices represents a compression trade that has historically resolved toward automotive silver in every prior episode where monetary demand and industrial demand converge simultaneously on a supply-constrained physical market. In 1980, at the peak of the last major energy-driven monetary repricing cycle, the gold-to-silver ratio compressed to 16-1. Not because anyone predicted it, because physical silver was being consumed by industrial applications that could not substitute away from it, while simultaneously being accumulated by monetary buyers who understood that fiat currency was absorbing an energy shock. It lacked the structural tools to neutralize. Both demand categories pulling simultaneously against a supply base that could not respond at speed. The ratio compressed because the math compelled it. The math is more compelling today than it was in 1980 on every structural variable that matters. The debt load is larger. The policy constraints are tighter. The supply deficit going into the shock is deeper. The industrial demand base that cannot substitute away from silver is broader. Solar fabrication alone represents a consumption category that did not exist in 1980 at any meaningful scale, and that accelerates precisely when oil prices make fossil fuel dependency politically and economically untenable. Now, let me tell you what to actually watch between now and Monday's open. Not the financial media, not the analyst notes, not the technical chart patterns generated by a pricing mechanism that was designed for normal conditions and is currently operating in conditions that are not normal. Watch the Shanghai Gold Exchange opening Sunday night at approximately 9 p.m. Eastern Time. The premium that physical silver commands above the COMEX Friday close in that session is your leading indicator for Monday morning in New York. If Shanghai Physical is trading at $6 to $8 above the COMEX paper close, the gap has begun to open in the way the 2020 episode opened. If the premium exceeds $10, the institutional demand absorption has already begun, and Monday's open will reflect a repricing that retail participants will be reacting to rather than positioning ahead of. Watch the dealer premium data, not spot. Spot is the paper fiction. The premium that major online dealers are charging for 1-ounce coins and 10-ounce bars for delivery in the next 2 to 4 weeks is the physical market speaking in real time. When that premium moves above $6 on standard bullion products on a non-panic Friday, the physical market is telling you something the paper market has not yet processed. When it moves above $8, the window that the 2020 template described is open. When dealers begin implementing purchase limits, as they did in March 2020 and again in early 2023, the window is closing. Watch Brent crude Sunday night alongside Shanghai. The two numbers together tell you the complete Monday morning setup. A Shanghai physical premium expanding while Brent holds above $89 means the cost floor repricing and the monetary demand repricing are occurring simultaneously. That is the 1973 template activating with 2026 structural amplifiers. The paper silver market dropped 13% this week. That number will be cited by financial commentators for weeks as evidence of silver's volatility, its speculative nature, its unreliability as a monetary asset. They will use it to argue for patience, for waiting, for technical confirmation before commitment. Those commentators are describing the map. The territory moved on Thursday morning when a 21-mile strait closed and the arithmetic of producing every ounce of physical silver on the planet permanently changed. Physical silver does not appear because a futures contract says it should exist. It does not get cheaper to produce because a COMEX price discovery session generates a red candle. It runs through the ground, through the crusher, through the refinery, through the freight network, every stage denominated in oil. That process now costs more than the paper price says the output is worth. That gap has one resolution direction. The only question that the historical templates leave genuinely open is not whether, it is when. And the answer, based on 3 prior episodes with identical architecture, is that the when is measured in the days immediately surrounding the external shock, not the weeks that follow once the financial press has finished explaining why the opportunity no longer exists. Drop what your dealer is quoting you right now in the comments, not spot. The all-in delivered price for a 1-ounce coin at the front of the current order queue. That number is the honest price. Everything else on your screen this weekend is a relic of a world that closed with the Strait.